Elon Musk's wealth grew by $121 billion in 2021. He paid $11 billion in taxes. That's a 9% tax rate. If you're earning a normal paycheck, you're likely paying 25 to 35%. Same country, same rules. Totally different results. These aren't illegal tricks or offshore scams. They're 7 legal tax structures written directly into US law, used by the wealthy every single year. By the end of this video, you'll understand exactly how each one works and which ones you can use yourself. Step-up basis. When you buy an asset, stocks, real estate, a business, and it goes up in value, you owe capital gains tax when you sell. Buy Amazon at $100, sell at $500, and you owe 20% on the $400 profit. But if you never sell, something wild happens. When you die, the IRS resets the asset's cost basis to its current value. It's called step-up basis. That means if your Amazon stock is worth $500 the moment you die, your heirs inherit it at $500. They can sell it instantly and owe zero capital gains. The entire $400 gain from your lifetime evaporates. Gone. This is why ultra-wealthy families rarely sell assets. Walmart's heirs used step-up basis to avoid tens of billions in taxes across generations. This loophole alone costs the US government roughly $42 billion every year. It's completely legal, and it saves the rich more money than almost any other strategy. For you, if you own stocks or real estate, long-term holding plus basic estate planning can erase taxes your family would otherwise pay. Buy, borrow, die. The wealthy avoid taxes by doing something counterintuitive. They borrow money instead of selling assets. If Jeff Bezos sells $1 billion in Amazon stock, he'd owe around $200 million in taxes. So he doesn't sell. He just walks into a bank and borrows $1 billion against his stock. Loans are not taxable, ever. Banks happily lend at 2 to 3% because billionaires don't default. Meanwhile, Amazon stock historically grows 10 to 15% per year, so his asset grows faster than the cost of the loan. He uses the borrowed money to buy homes, yachts, invest in companies, while paying almost no taxable income. Then, when he dies, step-up basis wipes out the tax on all those unrealized gains. His heirs sell stock tax-free, pay off the loan, and keep the rest. This is the loop. Buy assets, borrow against them, die, taxes erased. For you, if you own a home or brokerage account, borrowing against your assets can be more tax efficient than selling them. Qualified Small Business Stock, QSBS, is one of the most powerful tax breaks in the US tax code. Yet almost nobody outside Silicon Valley knows it exists. It lets founders and early startup employees sell up to $10 million in stock, tax-free. Zero federal capital gains. Zero. Here's how it works. If you join or invest in a qualified small business, usually a C corporation worth under $50 million, and you hold the shares for 5 years, the IRS wipes out the tax on the first $10 million in profits when you sell. If you're married, your spouse can claim their own $10 million exclusion. That's $20 million in tax-free gains per couple. This is how early employees at Airbnb, Uber, and Stripe turn small equity grants into life-changing wealth without paying traditional capital gains. For you, if you ever join a startup or launch one, make sure the company is structured as a C Corp before your shares are issued. One paperwork decision at the beginning can save you millions later. Donor-advised funds. Donor-advised funds let wealthy people get huge tax deductions today while giving the money to charity whenever they feel like it. A DAF works like this. You transfer stocks, crypto, real estate, or cash into a charitable account. The moment it hits the account, you receive a full tax deduction for the entire value, even if no charity receives a single dollar for years. Mark Zuckerberg moved $1.4 billion into a DAF in 2013. He claimed the deduction immediately, cutting his tax bill by hundreds of millions. The money still hasn't all been donated. Meanwhile, the assets inside the fund keep growing tax-free. Wealthy families use DAFs to wipe out taxes during high-income years and control their giving schedule decades into the future. For you, you can open a donor-advised fund with as little as $5,000. Donate appreciated stock instead of cash to avoid capital gains and get the full deduction, doubling the benefit instantly. Opportunity zones. Opportunity zones were created in 2017 to encourage investment in certain areas, but in practice, they became a tax deferral machine for wealthy investors. Here's the deal. If you sell anything for a profit, stocks, crypto, real estate, and reinvest the gain into an opportunity zone within 180 days, you can delay your tax bill until 2026. Hold the new investment long enough, and the appreciation inside the opportunity zone becomes tax-free. If you hold it for 10 years, you owe zero capital gains on the growth. This is why billionaires poured money into OZ projects, luxury apartments, hotels, and commercial developments in fast-growing areas. They defer taxes from old profits while building new wealth that compounds without tax. For you, some opportunity zone funds let individuals start with around $25,000. If you took big profits recently, rolling them into an OZ fund can delay taxes now and eliminate taxes later. Carried interest. This is the loophole private equity and hedge fund managers fight to protect every single year. When a fund makes money, managers take a cut, usually 20% of the profits. That should be taxed as ordinary income at 37%. But thanks to a classification called carried interest, it gets taxed like a long-term capital gain instead, just 20%. Here's why that matters. If a fund manager earns $50 million, the difference between paying 20% versus 37% saves them about $8.5 million in taxes every year. Steven Schwartzman, the billionaire CEO of Blackstone, made about $896 million in 2021. Most of it was taxed at the lower carried interest rate. If it were taxed normally, he would have owed roughly $150 million more. Congress talks about closing this loophole every year. It never happens. For you, this one doesn't apply unless you manage investor money, but it explains why fund managers become rich so fast and why their tax rate is often lower than yours. The 1031 exchange. Real estate investors use one tool more than almost any other to avoid taxes: the 1031 exchange. Here's how it works. If you sell a rental property and make a profit, you normally owe capital gains tax that same year. But with the 1031 exchange, you can roll that profit into a new property and pay zero tax today. You simply trade one investment property for another of equal or greater value. As long as you reinvest the profit within the IRS timelines, 45 days to identify a property, 180 days to close, you defer the entire tax bill. Wealthy investors use this to climb the real estate ladder. Duplex, small apartment building, larger building, deferring taxes every step. Then when they die, step-up basis wipes out the entire chain of gains. For you, if you own rental property, a 1031 exchange lets you upgrade without losing 20 to 30% of your profit to taxes. Just remember, this only works for investment properties, not your primary home. These strategies aren't secret. They're written directly into the tax code, and the wealthy use them every year. Now you know how the system works. If you want to deep dive into any one of these loopholes, tell me which one in the comments.